Good day and welcome back to the second episode of the Personal Finance segment. Ross, take it away.
Yeah, good morning, Randy and listeners. It was an interesting chat we had the other day and more on philosophical type of things. So I think today is more on how to think and what to use and where to go. I think that was more my idea. And we had like a bit of an agenda to talk about, a unit trust and the ETF and stuff like that. And this morning when I was sitting, I thought, geez, now we're getting to, I'm going to invest, but you don't know. I think you need to ask yourself, okay, so why would I want to invest and that type of thing. So I just did a bit of I guess everybody that's in finance or interested in finance do have a financial calculator, the normal stuff. It's quite simplistic, but it's actually quite powerful, and it's how we deal with people. And obviously, if you start to invest, do you want to invest because you want to go overseas and have a holiday, or do you want to invest because you're planning to retire someday? So the typical example, which I always use to people to say, most of people want to save or invest for their retirement. And a lot of the listeners would probably know that everybody you read and say you need to start invest as early as possible, start saving.
Yeah.
And I just did a bit of an interesting little sum, and I took Randy's age he's now 23 years old, and he wants to retire at 60, so 5 years earlier than the normal retirement age of like 65. And if you calculate, it's like you've got still 37 years, Randy, to get to like a very nice retirement at your seaside home somewhere, I assume.
Yes, definitely.
And what I did is, and I think if you've got a good qualification and you start your first job and you're one of the lucky ones and you start off with an income of 20,000 Rand a month.
Yeah.
And I just did a simple calculation, and I think we spoke about, I said when you can't save yourself rich, So my assumption that I do always with people is, okay, so you earn currently 20,000 Rand a month, and when you retire, you want that 20,000 Rand to keep up with inflation so that you can keep your lifestyle or whatever. And what's interesting, if you earn today 20,000 Rand a month and you say, okay, but what is that to keep up with inflation over 37 years? How much would I need to earn
to maintain
37 years from now? And that number, and I worked on inflation at 8%.
Yeah.
We know the inflation rate that they came out now is like 2.5% or 3%. And I always say, but it's a bit of a misnomer because it's a package that's predetermined. Each person's inflation would obviously be different. And if I look at mine, I think mine is more at 10%, but it depends on how you live, I guess.
Yeah.
And I would use just on 8%. And if you keep up with inflation, your income would be 345,000 Rand a month, Randy. When you reach your 60 retirement age, and that works out at about 4.1 million Rand per annum that you will earn. So that's what do you say about that?
That sounds pretty good.
It sounds pretty good, but you must just bear in mind you're still earning 20,000 Rand a month.
Yeah, that's what you don't factor in. Yeah,
and that's inflation for you. And what's interesting then is what we do to people is say, okay, so what capital amount do you need to have saved up to be able to draw that type of income? Because now you don't have a salary, you have now your own capital that need to give you that income. And interesting part of that is a lot of research has been done, and it's determined that you can't draw more than 5% of your capital per annum, so that your capital keep up with inflation and also your income after retirement. And interesting, I mean, the guys can email me or whatever if they want to have the detailed calc. But Randy, your lump sum capital that you would require to give you that income is 82.8 million rand in the lump sum that you would need by 60. And
That's
now
a
you say, okay, but how much
bonuses,
do I need to? Yeah, so now you must say to yourself, how much must I save today
to get
from
that
23 to actually get you to that number? And interesting though, and then I work at, and this is where the lead up to where we're going and where must I invest. And I worked at, you probably will want to earn at least inflation plus 5%. Now, if your inflation rate is 8, then you need to earn about 12% per annum over a period of time. Sometimes it will obviously be less, and sometimes it will be more, but on average, 12%. And then, interestingly enough, your investment amount per month that you need to start to save now is 10,000 Rand a month. So you can
That's
imagine.
half of my income, yeah.
Half of your income.
Yeah.
So I think that's just to a lead up in terms of, okay, so now we know why you want to invest and what is your time horizon, and you also know what is your expected returns that you need to get. And pretty much at that, say that 12%, that immediately put you in what we call a high risk investment. So i.e. in our life, we assume the highest risk you can take would be to be invested in the market.
Yeah.
Now, what is our market? For simplistic, we say our market in South Africa would be the JSE.
Yeah.
Now we know you need to invest and have exposure to the JSE. And I think that's where you get to the point, okay, so now what vehicle do I need to take to give me that 12% per annum return over time? And I think that was the lead up in terms of, okay, so now, I mean, you can, like I said, start your own share portfolio.
Yeah.
We will touch on that in the next episode in terms of shares and that type of thing. Or you can invest into a unit trust or into an ETF in terms of that's. So I think the important part of this first discussion is before you start to select the vehicle, you need to understand why and where you want to go with it. Because it would be totally different if you say, listen, I just want to go on a holiday next year, January. Where do I put my money? Then we know, we've discussed in the previous as well, risk. You don't want to, money, if it costs me 20,000 next year to go on a holiday, I'm not going to put that money, 2,000 Rand a month or whatever, into the market that can lose you in the next year 20%. You're going to put in your bank account because it's a short term.
Yeah.
But now we've determined for long-term saving, it's a 30 plus year horizon. We know we can take the risk, we can take the ups and downs. And now we get to say, but do I put my money in a unit trust? And or do I put it in an ETF that gives me exposure to that market risk? Does that make sense to you, Randy, in terms of the intro on why?
Yeah. I think it's a pretty good foundation. Something actually I haven't really considered. So then you mentioned okay, after I've done my analysis and decided why I'm investing and for what goal, because that's kind of what I took out from this. So what's your goal? Then you mentioned the two vehicles I can use. One's an ETF, one's a unit trust. So can we get into what a unit trust is and start from there?
Yeah, sure. Just where unit trust originated from. Now you can imagine if you say you want to buy a share and the share price of the share costs 10,000 Rand for the share. Now you say, okay, but I only have 500 Rand a month. So obviously you limit it and you can't buy that share. And that's where unit trust started off in terms of saying, listen, but if we pool 100 or 1,000 investors together and we take all their money, we can then buy a specific share. And that's specifically what a unit trust is. And I think the new word would be a collective investment, which is more specifically stating what it is. It's a collective amount of investors pooling their money together and investing that money into a range of shares. So a unit trust is actually the vehicle making it possible for anyone out there that wants to save to get access to a broad range of listed shares in the market. So that specifically is a unit trust. It's actually highly regulated by the Collective Investment Schemes Control Act. The shares or the units, so if there's now, instead of you having your Sanlam and Naspers and all the shares in a portfolio, you now get a unit in that specific portfolio. But each and every unit holder get the same exposure to the amount of shares that's in that unit trust fund. And we can touch on I will touch on the ETF, but I think if we
focus on unit
put that as a collective investment, because now you go to and say, listen, okay, so now I'm invested in a unit trust, and then you start to get, so listen, but what type of unit trust do I need to select?
Yeah.
And what's interesting is at the moment there's about, I would say, roughly about 1,500 different registered unit trusts in South Africa.
That's quite a bit to select from.
Yeah, it's a lot. And so now, how do you understand where to go?
Yeah.
And the industry made it a bit easier to put that into perspective. I mean, there's only now 344 listed stocks, you know, so there's a lot more unit trust funds than listed shares. Yeah. But just to understand what I know now in terms of a previous example, that you need to invest in equity. Now, the unit trust industry made it a bit easier, and they classified the unit trust in different classifications. I'm just going to stick with the main broad spectrum of unit trust. And it's again about asset classes. If you understand an asset class, now the main three asset classes that people use is either cash, you put your money in the bank type of thing, or you buy bonds listed by either government bonds or corporates, and the other portion is equity. So each classification of a unit trust are split according to a mandate, i.e. a mandate gives someone the power to manage it according to that mandate. So you can either be in a high equity, in other words, mandate that gives you full exposure to the JSE, or limited in terms of whether you've got a pension fund, that you limit in terms of how much exposure to equity and how much to cash and bonds, etc. Yeah. So in our instance, we now decided we need to invest in the market, and you can either, again there, it gives you an option to either just go for a fund that just track the market, i.e. it's an index fund, or you give to someone the money to say, listen, I trust you that you will outperform the index. And so immediately you get to the point and say, listen, okay, so then that means, per se, the one option that you can go for is an active managed fund. In other words, a fund manager that can actively trade around what's available in the market. And then the other option is a passive one where the guy just stick to the exposures of the different shares that makes up the JSE. So if Naspers is, for example, 10% of the index, he will buy 10% of Naspers. And then he tried to be as close as possible to the index. Okay. Or the guy can say, listen, but I'm confident in my philosophy that I can outperform the market by actively buying and selling different shares.
And why would one then choose to match the market? Like what decision, what would you need to be taken into consideration if you're choosing, I actually want to use an index fund, or I want someone to actually manage my funds?
Yeah, I think the main thing is, per se, the one would be if you say to someone, listen, I would just want you to track the market. Now you can do it yourself, you can track the market. So there's no additional IP and that type of thing going into your process. So I would pay you, there's a fund, call it a fund management fee. Now I always say to people, so if you pay more, you are expecting to get more.
Yeah.
So why would you go for an active manager? Because you would expect him, because you pay him more, to over time outperform the index. If the JSE is just doing 10%, I'm prepared to pay X company 50% more, because it's never a given, you know. So,
Yeah.
but you expect a person to say, listen, but if I pay you more and you're more qualified and experienced and processes, etc., that you will give me 12% a year instead of 10%. Or the other person say, listen, I'd rather be happy to pay less, but be happy to get the market.
Okay. And then
Does that make sense?
Yeah, that makes a lot of sense. But then now I'm thinking, in terms of structuring now, as like a young professional, so like I love how you like kind of used my situation now, right? So tying it back to when I start next year, then how do I navigate this? Like, how do I start investing then in it? After I've determined my why and I've determined, okay, I want to go through unit trusts. And now, as you said, there are two different options. Do I want to go index? Or so I just match the market? Or do I want someone to manage my money actively?
Yeah, I think the reality is, and I think that's what we experience. I mean, I do think that the reality is always different than what you expect. So I think that that's I think the big thing that we say to people. I mean, it's quite unrealistic, I think, to say, listen, you now suddenly got your first job, and I now need to put half of it away, because life goes on, and you find your better half, and you want to buy a house, and you want to buy a car, and you know you want DSTV, and you want to go on holiday, and then eventually you say, oh, geez, now I've got zero left.
Especially all these discounted flight prices,
So I think my experience throughout my life, which it wasn't designed by cleverness. I think it was designed by luck, maybe initially, to understand it. And I always started off with, okay, I'm going to start with 1,000 Rand. And then my 1,000 Rand is out. So I've got my 19,000 left. And then I work on that. Because it's always difficult to, in the end, so you make you start with your initial savings amount as part of your budget or part of your expense. So start at least with something than to do nothing. So next year you start with your job, and I always say to people, just sign off your debit order, even if it's only for 500 Rand a month, or take 1,000 Rand and say, I'm actually only earning 19,000 because the 1,000 is already gone. And now you start to say, okay, so I can afford 1,000 Rand a month, and then you start. You can always, obviously, if you get a good bonus or whatever, you can add and add and add ad hocs as you go.
Yeah.
To probably over time work out as you started at least with something, and maybe it grows to a lot more than the 10,000 Rand a month. But you started at the right point. You started as, I just need to start early. And then you say, okay, now, how do I go about it? And I think we will touch on where ETFs came from. And I think, personally, I'm the type of person that enjoy thinking or on the philosophy that a specific fund manager will be able to outperform the market over time. So you say, so if it was me, I would invest in a active manager, But you can now imagine when we started off, there was, say, 6 or 7 managers available. So it was easy to find the one that can prove he can outperform the market over time. And that's where this index fund started, because less than 50% of active managers consistently are able to outperform the market. So people started to say, gee, whiskers, so now I'm paying you more, but I might as well just buy the index, or an index tracker fund that's costing me less. And I think you can imagine with 1,500 unit trust, you know, say, where do I start?
Yeah.
And that's exactly where index funds started. And then eventually index funds started to convert to ETFs, exchange traded fund, which is pretty much the same as a unit trust, with a few nuance differences, where a unit trust are only priced once a day. So we pull everybody's money together and we buy the shares, and at the end of the day, they calculate the price of the ups and downs of all the difference, the aggregated ups and downs of all your instruments, and then the amount of unit holders, and it gives you a price. Where an ETF was an instrument created, also giving you exposure to different indexes, whether it's the JSE or financial index or MSCI or all sorts of, you can have all sorts of different ETFs or exchange traded funds. But now that fund trades like a share, with people buying and selling, and people as the day is also listed.
Yeah.
So, and it started to get even more cheaper than a unit trust fund. And I think that's where people start to invest in that type of vehicles, because it gives you the market, but a lot less cheaper. I think as technology grow and the markets get more sophisticated, you start to invest. And I always say to people, because your question earlier was, so how do I now navigate myself?
Yeah.
And I always say to people, I said, if you the type of person that educated yourself in financials, and you understand your own, you know that you're disciplined, you are that type of person that can manage your budget, and you understand investment, you understand the risk, and you want to be on top of it every day, and you don't want to, then I always say to people, but if you, then, you know, you just go and buy an ETF, you know, so take your 1,000 Rand, buy an ETF, it doesn't cost you money. Or the other option with people, they come to people like us and say, listen, I need a mentor to help me through this process, because I don't know, I can't budget, or I can't do this and I can't do that, I don't understand planning. Then they come to people like us, and because what we do as a job is to go and find that active manager that over time can outperform the market.
Yeah.
You know, so, and the proof is in the pudding. Personally, I love a unit trust funds, because it's your performance is always audited performance. It's not someone saying something. You can actually go and look and say, oh, so Ross is managing this fund and his performance was 8%, and it's audited, it's in the public eye. But Ross, what did you do wrong because the market did 10? You know, so it keeps you honest. So that's why I'm a personal fan of a unit trust fund.
More
but an
transparency.
ETF is just as great, call it a vehicle, especially for people saying, listen, I'm happy with the market. I'm happy to get the market. I'm not going to try and gamble on selecting a manager, though knowing I might get it wrong 9 out of 10 times, selecting the guy that could not outperform the market. You know, so
okay, I
does
think
that answer your questions of how to start off? You know,
yeah, it definitely
it's easy.
it gives me a lot of
You
perspective.
phone someone like us or a company and you say, listen, I'm getting my first check in the next month. Please send me the application form. I'm starting with 1,000 Rand. That is how you start. Don't wait until you spend your money and see how much you got left over to save. Decide on the number first.
And then start.
You know, so I think that's And we see daily, I mean, people just do not start early enough.
So always waiting for like the right time, trying to like time the market and stuff like that. Well, that's also something I've noticed. Yeah, a lot of people do.
Yeah.
So I think that's like really, really like insightful advice where you just have to get started, you know, and you learn over time, as is, you know, everything, it's growth.
Yes, and I think that's touching earlier again, you know, it's like your saving is always trying to keep up with inflation and building yourself your retirement package. It's not, investments is not that type of thing you want to say, listen, this will get me rich. And eventually, as your salary, obviously, I mean, if any young person that start off working, I mean, surely you just don't want to earn the salary that keeps up with inflation.
Yeah.
You want to take more jobs, more managerial positions, or so that you can actually extrapolate your income levels, because I think that's the reality. Some people just earn their little salary and it goes up with inflation. It keeps them happy through life. And other people want to earn more and to be more successful. And obviously with that and responsibility, your salary will increase with way more than inflation. But then if you already started your process now, you can say, listen, I'm keep on going with my 1,000 Rand a month or whatever, but I now earn a bonus of 2 months extra salary. So now suddenly you've got 40,000 Rand.
Yeah.
Extra money. And you say, okay, so what must I do with it? And I think at that point you can say, listen, either you top up on your existing vehicle, or you now say, listen, but I'm now want to take on more risk. I.e., I want to buy a few shares, or I heard this company, you know, it's like buying it at 1 Rand and it's going to send the next plane to Mars in 20 years. I mean, you can, if you follow the US markets, I mean, you can see what a company like Tesla did in the last few months.
Yeah, they just went crazy. Yeah, I think it's
Yeah, so obviously, if you're at that position, it's like you time it. I mean, it's never a guarantee, but people feel it's working, and that 20,000 Rand are put into a Tesla, but you were happy to put it there. It might halve, or it might go bust. And that's where you take on extra risk after you earned extra money. But you still keep on with your long-term savings plan. You don't deviate from that plan. And I think, or you start a business, or you say, listen, I'm going to start my own little business with that extra 20 or 40,000. And that business might skyrocket in something else in 20 years from now, and someone else come and buy it out for 20 million.
Yeah.
That's how you shift yourself from just keeping up with inflation.
So then is that how you is that how you get
into a whole different but you took on very high risk on that extra money, but you didn't touch on your long-term savings plan. But I think the fault people make is they go on great for like 2, 3, 5 years or 10 years, and now they build up their retirement package to a number, and now suddenly here comes an opportunity that they feel, gee, this thing can make me rich, and then they take their long-term savings plan, pull the money out, put it into something where they can lose 50% or 100%. You know, and I think that's always why I said keep it separate. You know, keep your long-term saving plan separate from the other stuff that you want to do.
That's where the discipline comes in.
Exactly. So yeah, I think that's, I don't know whether you've got any specific on ETFs. A lot of people use ETFs in our world as a building block, approach. So you can also do that. And so listen, because it's also risk management. So you say, listen, the building block, an ETF, it's a cheap way to get the market. But now I'm going to build satellites around it to try and give me a little bit more upside.
Okay.
That's also one way to do it. You say, listen, 50% of my money, I'm just going to go to the market. and the other money I'm going to give to a person like Ross or Pete or Gert. And if one or two of them give me more than the market, the other one take a bit, then in combination, I would get a bit of more of the market, but half of it was cheap.
Yeah.
You didn't pay too much for it.
Yeah.
That's one angle that a lot of people are using ETFs as a good cost-effective building block, and then add a Warren Buffett or a Tesla examples around it, so because you always want to get a bit more than the market. I mean, otherwise, if you're in our industry and you're interested in it, you will never just be happy with average, I guess.
Yeah, you always want to, I guess, extrapolate more. I think that's all for today's podcast. Thank you so much. I think it was really insightful. I think I was looking at my notes I made before, and I just adjusted a few things, that I had. So thank you so much for that. And to all our listeners, thank you so much for listening in. Remember that.
Thanks, Randy. Thanks for the time again. I know it's a little time to touch on a lot of things, but if it's purely the end result of people making them more interested, then I think we can take it from there.
Yeah, I think it's a great value add. And to all our listeners, thank you so much for tuning into this week's episode. If you have any requests or any questions for Ross, I'll leave his LinkedIn profile link in the description below, and his email as well. If you have any questions that you can shoot over his side, and if you have questions for us, remember you can send it to any on our email. Will also be linked in the description box, and you can also contact us on all our social media platforms. Remember to subscribe to all our social media platforms. Our handle is @FinChatCo. We have a weekly newsletter that we release every single week, so subscribe to that, and remember to give us a favorable rating on all your podcast platforms. From FinChat, the personal finance segment. We'll see you next week. Thank you.